Hello everyone, this is Tom Siomades, Chief Market Economist here at AE Wealth Management. We've been saying the second half of the year would be much more eventful, and that has definitely come to pass in the third quarter. July started off with a bang as small caps led the way in what was dubbed the Trump trade after President Biden's disastrous debate performance that pretty much sealed his re-election fate. We saw a rotation away from technology, green energy, and other sectors. Industries like traditional energy, oil and gas, for example, and defense were viewed as the beneficiaries if former President Trump was elected. Small caps spiked as they had lagged pretty much all year and were seen benefiting from the potentially lower regulations and red tape from Trump policies. All was going great until about mid-month in July, but that changed in a hot minute. In an unprecedented move, Biden stepped aside and current Vice President Kamala Harris was installed as the new Democratic nominee. The Trump trade fizzled because the presidential race once again became competitive. As a result, the market was very volatile in the back half of July as concerns of economic slowdown, recession, and inflation all crept back into the conversation. Without a clear direction, and with the Bank of Japan raising rates to levels unseen in 15 years, the so-called Japanese yen carry trade collapsed and markets tanked on August 5th. Traders were borrowing cheaply from Japan, using the funds to buy other assets in other countries, and when the Bank of Japan raised rates, it forced the traders to unwind that trade. The volatility index, known as the VIX, topped 65, a level we had not seen since March of 2020 and during the early part of the pandemic. Markets spent most of August climbing out of that hole and finished the month pretty close to record levels that we recorded in mid-July. The Federal Reserve chose not to cut rates at the July meeting, even though it would have been prudent. But Fed Chair Jerome Powell kept the rally going with a speech following the Jackson Hole Symposium, which telegraphed and pretty much solidified the expectation of rate cuts starting in September at the Fed meeting. However, the rally did not last long as markets began again to fret over slow economic growth and a weakening jobs picture. Although gross domestic product, or GDP, for the second quarter jumped up to 3% from 1.4% in the first quarter, people still were not feeling great. Inflation has finally dropped below 3% to 2.5% as measured by the CPI, or Consumer Price Index, but the scars of the last 2 years are still fresh. Remember, we're talking about the rate of increase. Prices are not retreating and are a good 20% higher than they were 4 years ago. The rate of increase has now only begun to approach what the Fed would like to see. Some of that decline in the rate of inflation can be attributed to the decline in the price of oil, which currently stands at around $70 per barrel. The average price for regular unleaded gasoline is about $3.15 per gallon, significantly lower than it was this time last year, but not as low as it was in 2020. The challenge is that the price of oil is down because there is a slowdown in demand globally rather than an abundance of supply. There was some improvement in CPI when August numbers were reported in the first third of September. We dropped from 2.9% to 2.5%, which prompted the Fed to cut 50 basis points at the conclusion of its September 18th meeting. There was a lot of hand-wringing as markets digested the jumbo cut. Why a 50 basis point cut when Powell is telling us the economy is in great shape? Does he know something we don't? And with the presidential election getting more heated, if that's at all possible, was the cut somehow politically motivated? All that could have been mostly avoided had the Fed moved by lowering 25 basis points in July, as I mentioned earlier. A 25 basis point move in September would have still gotten us half a point lower without all the additional questions. Initially, markets rallied on the cut, so the jumbo cut was largely welcome as far as the stock market was concerned. We hit new records, but markets remained volatile to end September. Earnings for the second quarter were mixed, but mostly decent. There are signs of deterioration as people spend more money to buy less things. They are also carrying higher credit card balances, and higher interest rates make those balances extra painful. So far, companies have fared well due to a resilient U.S. consumer who continue to spend, but the signs of fatigues are everywhere, and with savings gone and credit cards tapped out. The recession that has been predicted over the past 2 years is finally beginning to look like a real possibility. If the consumer rolls over, we most certainly will dip into recession. So much is riding on the Fed threading the needle to keep the economy in balance and on the right path. I'm not as confident as some are that the Fed can manage it. Since we're on the Fed, I'm still calling for rate cuts for the remaining 2 meetings this year. The 50 basis point cut last month did a couple of things. First, it sealed the end of this recent rate cycle, so this higher for longer is not a thing anymore. Second, we actually saw a rate cut rather than a pause on the old hope and wait for next time routine like we have seen in the past. Will this half point make a difference? Perhaps. All eyes are now on the next two meetings in November and December and whether the data continues to deteriorate to the point where the Fed needs to make bigger cuts. In my view, the Fed either buckled to either market or political pressures or both, so now the markets will demand more and more aggressive cuts. The danger here is that the data could outpace the Fed's ability to react. Will the Fed be trying to catch up by being mechanical and methodical rather than dynamic? In trying to plot a perfect glide path for a soft landing, will the Fed forget to lower the landing gear and crash us into a recession? Or will the Fed move too aggressively, spooking markets, which will then think there's a lot more wrong beneath the surface? Finally, there's the potential for reigniting inflation. All of this could have been avoided if the Fed had cut 25 basis points in July and again in September, then taken a wait-and-see approach as we closed out the year. The yield curve has mostly flattened, with yields at 3.5% to 4% up and down the curve. Spreads were relatively tight but have begun to widen, as would be expected with volatility perking up. Yields declined pretty much all last quarter, with the 10-year Treasury at about 3.7% compared to a range between 4.2 and 4.7 in the second quarter. The inverted yield curve is now virtually gone, depending on what day you look at it. The recession, which an inversion was supposed to foreshadow, has not materialized, but it looks more and more likely to happen than it did in the past. Money and market CD rates have also declined and are still much higher than they were just 4 years ago. You may have missed the most recent top, but compared to where rates have been, getting 3 to 4% to ride out this volatility is not too bad. It's hard to believe there are only 3 months left in 2024. I've been stressing all along that the second half of the year would be a lot more eventful than the first half, which was a pretty good one for the markets. This upcoming quarter will be a bit spicy as well. We have the election to deal with, so I expect this volatility to continue into November. Volatility is a natural part of normally functioning markets, and it is the price of admission to the world of higher returns. This is why you have a plan. If you're uncomfortable, have an honest discussion with your advisor about the types of risk you're willing to take, and adjust your approach if you need to. If you have been letting things ride and are out of balance, get yourself back in balance as soon as possible. I said this last time and I'll say it again. We're in for some turbulence in the second half of the year, so turn off the cruise control and take a firm hold of the wheel. I'll be back with you to recap the fourth quarter and preview 2025 in a few months. Expect volatility to remain with us in October and early November. Stay focused on the long term, don't be a speculator, and look for the quick fix. Instead, be an investor and let the averages and probabilities work for you. Keep ego and emotions in check. There's nothing wrong with checking in with your advisor regularly to discuss your goals and concerns. It's what they do. My final bit of advice: the conversation about your financial journey should go two ways. Do not be passive, but be decisive and disciplined and articulate your goals. Enjoy the upcoming holidays with your friends and family, and please reach out to your advisor if you have questions or concerns. Make sure your goals and objectives are aligned with your portfolio and strategy. I'll be back to recap the fourth quarter in 2024 after the holidays. Until then, thank you and take care.